over the session. Welcome to Next Gen Mentoring Forum. The Next Gen Mentoring Forum series is to empower, educate, and illuminate individuals who are already in or interested in the financial planning industry. At each forum, an expert will discuss the topics in the area of financial planning with the purpose of inspiring critical thoughts and discussions. In today's session, I will interview Jeremy Witbeck for the topic on the year-end investment planning. My name is Chia-Li Chien. I am the Assistant Professor and Director of Financial Planning Program at California Lutheran University. I maintain an active financial planning practice specializing in succession planning program management at Value Growth Institute. I have authored 3 award-winning books, most recent peer-review book published by Pelgrim Macmillan entitled Enhancing Retirement Success Rate in United States. Next Gen Mentoring Forum is sponsored by California Lutheran University School of Management Financial Planning Program. We offer MBA in financial planning that helps advisor pursues a leadership position or grow their financial planning practice by deploying advanced financial planning, effective client communication, financial counseling, streamlined practice management, as well as leveraging fintech. It is an honor for me today to interview Jeremy Witbeck. Jeremy is a partner at Polaris Wealth and a member of the business development team. Jeremy meets directly with clients and prospect clients to communicate Polaris Wealth Management investment strategies and review all financial planning needs. Jeremy graduated from University of Arizona, where he earned his bachelor degree in accounting. Additionally, he is our alum. He graduated from California Lutheran University, where he earned his MBA in financial planning. Jeremy has an extensive background in the financial service industry and holds the Chartered Financial Analyst designation and is a certified financial planner professional. In his free time, Jeremy enjoys playing basketball, softball in the local leagues, and spending time with his wife and son. Jeremy, if I remember correctly, you have the second baby, is that correct?
Yeah, that is correct. I do have 2
now.
now.
Congratulations.
Thank you.
And Jeremy also teaches the graduate level coursework at California Lutheran University. So welcome, Jeremy. It's such a pleasure to have you here. Today we have such a turnout, and I really, really hope that we'll be able to get questions, answers. For those of you who have questions, feel free to type that into the group chat box, and we will do our best to answer every questions out there. So Jeremy, why don't we get started with just looking at the tax code refresher quickly, so then everyone is on the same page in terms of how much we can put it into our plan, how much we can invest accordingly for this year as well as next year.
Yeah, thank you so much for the introduction, Jolie. And the way that I envision this conversation going with everyone today is we're going to start with more of the basic fundamentals of the tax code, and then that will give us a nice foundation to talk about some of the more advanced planning techniques that we can take advantage of, understanding how the core of the tax code works. And this is an area where the way that a lot of us learn about it in school isn't quite the way that it's the tax code is functioning anymore, because there's a pretty significant tax overhaul that took place in 2018, which is still the tax code that we have today. And so a part of that tax code was, first of all, lowering the marginal tax brackets to where a lot of the marginal and the effective tax brackets for individual taxpayers went down. The other piece that happened is the standard deduction, which is something that everyone can kind of default to when they calculate their tax return, went up. And it actually went up pretty significantly. And this accomplished a couple of different things. The biggest being that for a lot of people, the tax code was greatly simplified because you simply plug in your income, you take your standard deduction, few other things, and then you apply your tax rate and you're done. So that was the one major thing that came out of the revised tax code. But there were also some things that were taken away or limited with that increased standard deduction. The first thing is that the personal exemptions were completely eliminated. So you no longer calculate and add a personal exemption on the tax return for each person. The other part, and this is something that was especially felt by the coastal areas, is the state and local tax deductions were capped to $10,000, whereas before it was unlimited. And so areas where there's a higher cost of living, especially higher property taxes, really have felt that. That's probably one of the most contentious areas of this new tax code, is that that cap up to $10,000. A couple other things that were changed that really impact a lot of individual taxpayers is that the itemized deductions for mortgages was lowered. So we used to be able to write off the interest on a $1 million loan and an additional $100,000 of home equity lines of credit. That's now been limited to $750,000 of a loan. And then lastly, there aren't near as many itemized deductions that a person can take advantage of. The biggest one that really caught a lot of people unawares is that a lot of business or work-related expenses that we used to be able to write off are no longer able to be written off. And then lastly, there was a piece that went through that really helped business owners, especially small business owners, is that there's now a 20% pass-through allowance where you're able to pass through some of your income from your business to yourself without the commensurate taxes that are normally attached to it. Now, one big caveat on all these updated rules is that they're set to expire in the year 2025. And so if we don't have an extension or tax reform before that time, these tax rules will revert back to what we're more accustomed to, especially if we learned about the tax code prior to 2018. And so there is a lot of impetus on Congress to potentially make some changes here, since these are all temporary in nature.
And so one quick things to kind of mention to everyone is that 20% pass through is not necessarily all type of business. They are selected type of business work.
Yeah, absolutely. And so there's certain criteria that have to be met, and certain types of industries were specifically excluded. And so that's one of those areas where if you are potentially eligible, you certainly want to talk to your tax professional to see if that's something that's attributable. But that's a great point, Chia-Li, is that not everyone will be able to benefit from that. And so there, as I mentioned earlier, a lot of the areas have been tightened up to where the tax code is a lot simpler, but there's also not nearly as many areas to tax plan, or in other words, to either avoid or defer the recognition of taxes. One area, though, that is still ripe for tax planning, and that we can do a lot to try to either defer taxes or in some cases eliminate taxes altogether, is in retirement. And I'm going to also include in there healthcare accounts. Technically, they're not retirement accounts, but they kind of get talked about in the same breath when we look at these things. And so one of the things that we still have access to are contributions into a 401k plan. And so the 2021 and the 2020 contribution levels are actually remaining the same, where every individual that has earned income from their job up to this amount can contribute $19,500. Or in other words, as long as you have $19,500 worth of earned income, you can defer up to that amount into a qualified 401k plan. There's also a catch-up provision for those that are over the age of 55, where they can contribute an additional $6,500. So this is one of the primary vehicles where we encourage and recommend people to defer money for their retirement years, especially if you're in a higher tax bracket. With the intent being to defer the taxes now when you're in a higher tax bracket and then pay the taxes down the road when hopefully your income levels drop as you're in retirement. If you're not someone that has a 401k plan offered through your employer, right, there's also the IRA vehicle that you can save into. And the 2020 and the 2021 levels also for this are unchanged, meaning that they were $6,000 for this year, and then they will also remain at $6,000 for next year. There's also a catch-up provision for those over the age of 55 of $1,000. Now, the health savings accounts are relatively new when it comes to tax deferral type of accounts. And health savings accounts actually are one of those few accounts that get the best of both worlds. And so what that means is that when you save money into an HSA account, not only are you able to save the money on a tax deferred basis, meaning that you don't pay any taxes, but if you pull the money out of those accounts for qualified healthcare expenses, it also comes out tax-free. So we talk about in life that there's two certainties in life, death and taxes, right? This is actually a legal way that you can completely avoid taxes is by using a health savings account. I think this is one of those areas that's oftentimes overlooked and can actually be a significant opportunity for a lot of people. Now, in order to contribute to a health savings account, that requires that you have a certain type of healthcare plan, which is called a high deductible healthcare plan. And so that's something that you'll want to look into with your offerings at your employer to see if you have that. If you don't see a high deductible plan offered, you should certainly reach out to your HR representative and see if that's something you can do, because this can be a great vehicle to save for a rainy day if any healthcare problem should come up. Now, every once in a while, you'll get someone that doesn't use up all the money in the HSA plan. So what if you've remained relatively healthy, your HSA account's built up to a pretty big amount, and it doesn't look like you'll realistically need all that for healthcare? Well, the Congress has enacted a policy where once you're retired, you can actually tap into your health savings account and treat it like an IRA account, meaning that it would be taxed just like a traditional IRA account. Now, you'll lose the benefit of being able to pull out of it and not have to pay any taxes. However, this can be a great vehicle to help supplement some of the income that you're pulling in retirement because it has that same tax treatment.
So we have a couple of questions in the chat box, Jeremy, if you don't mind.
Sure.
And I also have questions, so then we can kind of answer a lot of these all together. So the first question there is about Roth. So let's talk about Roth in just a moment, but I wanted to circle back on one of the questions regarding about it is not a mutually exclusive when you're talking about 401k contribution and IRA contribution. So could you talk a little bit about, for those people who have qualification to contribute to 401k or 403b plan, but at the same time, they could qualify to contribute to IRA. So can you talk a little bit about that before we talk about the Roth?
Yeah, and thank you for mentioning that. So when I say 401k plan, for most planning purposes, you could include a 403b or 457 plan in lieu of the 401k plan, because by and large, they're treated the same, at least for the purposes that we're talking about today. Now, there's certain differences and actually advantages that the 457 plan has that a 403b and a 401k plan does not have, but for tax planning purposes, they're more or less the same. Now, you mentioned a great thing, which is a traditional versus a Roth account, and that's both on the IRA side as well as the 401k side. So the way that the tax code's currently enacted, there's actually income limits that prohibit you from potentially contributing to a Roth IRA account. And so once again, you'll want to speak with your tax planning professional to see if you qualify. Whereas if your company offers a Roth provision on your employer-sponsored plans, like a Roth 401k or a Roth 403b, there aren't going to be the same income limitations. And so for those that are looking to defer money in a Roth account, that may open up opportunities that generally aren't available to you in the more traditional IRA account. Now, if you're not familiar with why would I want to do a Roth versus a traditional account, the way that a traditional account works is you put the money in tax deferred, and then when you retire, you pay taxes on the back end. A Roth account's the opposite, where you put the money in after taxes, so you'll still pay taxes on that money that goes in the year of that contribution, but when you take the money out down the road, it's going to be after tax. Now, if you're curious, well, when should I pick one versus the other? So the math actually is really simple for this, and it's all going to depend on what is the tax bracket now versus the tax bracket when you take the money out later. If your tax bracket's lower now, right, you want to pay the taxes now, and so the Roth would be the better option. If your tax bracket's going to go down later, well, then you're better off using the more traditional method of saving because you'll pay less taxes down the road. And so all the differences in between cancel out to where it all comes down to whatever your effective marginal tax bracket is at that time versus today will make your decision. Now, the hard part with that is that, of course, the tax code will change and we don't really know where it's going to be down the road. However, there's been a lot of trends that we can make a pretty good guess as to which one's going to be better. And so the general rule of thumb, and once again, this is a rule of thumb, but if you're in the 30% or higher tax bracket, absolutely you want to defer and use a traditional method. If you're in some of those lower 22, 24% tax brackets, there's a strong argument to be made that you may be better served by using a Roth option because it's highly unlikely that you're going to pay much less than that in retirement. And in fact, I would argue that it's more likely that you pay more than less.
So questions that I oftentimes either students or clients get confused is that, let's say you're qualified to contribute to 401k, 403b, whatever.
Well, I think we lost Chia-Li.
Just keep double dipping on both accounts.
Yeah, so once again, there are going to be income levels, income limits on whether or not you can actually deduct the contributions into an IRA account. And so the simple answer is you can always contribute to an IRA account in the amounts that I listed there. The question is whether it will be a tax deductible contribution. So you may have to make an after-tax contribution into an IRA account if you make too much money. And so you'll want to look at the income tax levels to see if it's deductible or not. If it's deductible, that means that if you made $100,000, for example, and you put $6,000 into an IRA, you will be taxed as if you only made $94,000 that year. If it's not a deductible IRA contribution, you would be taxed on the full $6,000. That basis will eventually, when you retire, come out of your IRA account tax-free, but any growth on those earnings will be taxable. So it's kind of like an in-between point between an IRA and a Roth IRA when you're not able to deduct the contribution into it, where your basis comes out tax-free, but you still are taxed on the gains.
So to kind of wrap up on the qualified plan versus the traditional IRA and Roth, the key is that lower tax bracket is best to go into the Roth account. The higher tax bracket is best to defer those taxes. So one good example would be, I do my daughter's tax return too. So as she is in a lower tax bracket, every single dollar is going to Roth in her account. Versus in our situation, we're not necessarily in the highest tax bracket, but it still makes sense for us to defer into our 401k or 403b plan. Now, there's one question in the group chat box I want to get to in just a moment, but one of the questions that even most of people are asking is probably best to kind of prepare or estimate your annual income currently and able to decide what you can do. So what is your recommendation in terms of helping clients to come up with a solution? Because our cutoff day is coming close in terms of how much we can put into these accounts. So what's your recommendation in terms of helping clients to do?
Yeah, so this is one of those areas where I'm a strong proponent for paying yourself first. All right, so if you do that, then a lot of things fall into place. And so as you wrap up the year, if you haven't maxed out your 401k and you have the financial means to do that, I highly encourage that you do that. And whether or not that should be in a traditional 401k plan versus a 401k Roth plan or 403b, 457, whatever that may be, I would start there. That's always going to be your best spot. With regard to the IRA contributions, you have until your tax filing to actually make those contributions. And so you have a little bit more time to figure out what you want to do there. Once again, if you have excess funds above what you're able to put into a 401k, 403b, 457, then certainly max those out as well. And this is where we get into the compounding of money, that the sooner you can get the money working for you, the younger you are, that money will snowball into a much bigger amount. So if you can get into the practice of maxing out these accounts early in life, you're going to retire far more wealthy and actually have to save less in terms of dollars saved in order to reach your goals. And so that's a behavior that that we should really be teaching our children. So Jolly, you mentioned that you're doing a Roth account for your child. That's outstanding. And in fact, that is one of the first things that we tell people to do if their child has earned income, is start them on the path of saving into a Roth account. First of all, they'll start to understand the difference between these, because they are confusing at first. And second, you're teaching them to live within their means and to start saving for their future. So it's a great practice, and one that definitely encourage all those that are attending to start doing if you're not already doing.
Yeah, so just to wrap up on the Roth account. So in the summertime, I reported back to my daughter, saying to her that, hey, you only invested for 2 years, but I'm able to manage your account up for 164%. She was like,
Wow.
is that good or bad? And I'm like, honey, 164% is outstanding. So yeah, so you can imagine that 164% growth in her tiny little account of the Roth IRA is also, when she take out the money later, much later in her life, it's all tax-free. So it's actually a great way of doing that. I want to get to the questions in the chat box. In terms of health savings account, there's also a flexible spending account. Can you kind of talk about the difference between the two? And then I'll come back with one follow-up questions on that.
Yeah, so there's a lot of confusion between an FSA account and an HSA account, or flexible spending account and a health savings account. So they're not the same thing, although they have a lot of the same purposes. So a flexible spending account is one that you put your money in tax deferred, and it comes out tax free if it's used for qualified purposes. However, it has a use it or lose it mechanism to it, meaning that you have to spend most of the funds within that same tax year. In some cases, there's an allowance where you can roll maybe $500 of what you saved into the next year plan. That may or may not be there, and that's really dependent upon the employer. But there is a tendency to not save very much money in those, because if you don't spend it, of course, you lose it, and now you're kind of shooting yourself in the foot. HSA accounts don't have that limitation. That money stays with you. So it's very similar to how an IRA works, meaning that it's portable. You can move it to different institutions. It's your money. It just has to be used for qualified purposes, much like an IRA. So the health savings account is an excellent vehicle that you can accumulate even more than you believe that you're going to spend on healthcare purposes, because it has that double benefit of being tax-free or tax-deferred going into the plan, and tax-free if used for qualified healthcare expenses.
And my follow-up questions on the health savings account is that for those of you who qualify to have, who qualify to be in a high deductible health care plan, you'll qualify to have health savings account. So the questions to you is that, so let's say that we're pretty healthy, we haven't spent anything out of the health savings account. Can I actually invest those money? And what do you think about that?
Yeah, so depending upon the custodian that you're using for the health savings account, many of them will allow you to invest a portion of the money. So for example, I'll just use the one that I'm in. The one that I'm in requires that I save, or that I keep $1,000 of the account value in cash for healthcare expenses, and the rest of it can be invested. And so you're able to achieve market-like rates of growth if that's what you're desiring to do, so that it can truly grow into a sizable nest egg, either when you need it down the road for other healthcare expenses, or retirement if you don't end up needing them before then.
Yeah, so that was something that we also have the same thing, where there's a minimum threshold, and then the rest that I think the custodian that we have through the account was TD Ameritrade. So, but definitely I would advise everyone to at least work with your financial advisor to make sure that whatever is necessary to invest, the medical portion, the health savings account is still dedicated for medical purposes. So your investment risks might have to kind of scale down a little bit for that purposes. All right, so let's talk about these popular things. You know, every new administration come through, there's going to be some changes in taxes. In my personal observations for the last 4 years, there are a lot of spending. Plus this year, the pandemic, the Congress is continuing to proposing new stimulus money. The money has to come from somewhere. So the concern is that tax may or may not potentially go down or go up. We don't know. So talk to us about what these proposals might potentially impact us.
Yeah, and I'll throw out one resource for you that I found especially helpful as I looked at this, which was taxfoundation.org. They've done a lot more analysis on this than what we'll be able to get in today. So if this is something that you're interested in, that's a great resource. And they really did their homework on trying to understand this. And the other part is this is a little bit of a moving target. So depending on the speech that you want to pull the data from, it's changed a little bit over time, but as best as I can tell, this seems to be the overlying theme on what's being proposed. And to say it very succinctly, what the tax plan is attempting to accomplish is to increase the tax rate on those individuals, or those households rather, I should say, well, in some cases individuals, some places household, that make in excess of $400,000. So the one thing I think that should be recognized that isn't really recognized here is that making $400,000 in a state like California or New York or Hawaii is not the same thing as making $400,000 in a state that has a much lower cost of living. Unfortunately, however, that's not really addressed here in this tax code, or it looks like it'd be a pretty flat structure across all the different states. Really what's being proposed is to raise the marginal tax bracket, both on a marginal and an effective rate for those individuals and households that make more than $400,000. The other part is to eliminate the qualified long-term capital gains rate on those individuals as well that are making capital gains in excess of $1 million. And so currently the tax code tax capital gains at, well, anywhere between 0 to 20%. It's a tiered structure. And then there's also the Affordable Health Care Act surcharge, which is an additional 3.8%. So the top tax bracket's about 23.8% on those qualified long-term capital gains. And the proposal is to raise that tax bracket up to 39.6%. So to be in line with the top marginal tax bracket on earned income. The other part is addressing the Social Security and Medicare shortfall that we're anticipating that we'll have. And so the way that that's structured currently is that you're taxed on your earnings up to a certain point. And then once you exceed that point, you no longer are paying any Social Security taxes. And so what this proposes is to leave that intact, but then once you get above 400,000, you'll pay 12.4% again on those earnings. And so it's going to create sort of a donut, if you will, to where you'll have a tax holiday. And then once you exceed a certain threshold, once again, you're paying those taxes. The last thing is, or I should say the second last thing, is capping the benefit of itemized deductions to 28% for those that have earnings more than $400,000. And so what this is trying to do is it's trying to enforce the 39.6% tax bracket that he's looking to achieve, and not allowing tax loopholes or tax planning strategies to cause a taxpayer to pay something significantly less than that. And you'll notice that that theme is also true on corporations, which we'll go through in just a moment. The last thing, and this is impactful for those that have perhaps wealthy relatives or wealthy family members, is that there's a proposal to lower the estate tax to 2009 levels, which was about 3.5 million. So if you're not familiar with the estate tax, there's actually different tax codes within the US. So a lot of what we talk about is the income tax code. There's also an estate and gift tax code. That is the tax code that impacts individuals when they pass away, and the money that they leave to their heirs or charities or whomever or whatever they select. And so at present, you are able to leave a little north of $11 million per person to your heirs without any estate taxes. So it means that a husband and wife, if they were to pass away, they could pass up to a little over $22 million to their children, as an example. The proposal here is to reduce that amount to the 2009 levels, which was 3.5 million. So husband and wife could leave up to $7 million without any estate taxes. I didn't see that they're going to make any changes to the estate tax rate. And so at present, the estate tax rate is about 45% of assets. So a little under half of the wealth that's transferred above those levels goes to taxes. And then I mentioned earlier, the corporate tax rates weren't left unscathed either. So the proposal is to increase the corporate income tax rate from the 21% to 28%. So a pretty significant increase. This is actually an area that I find to be the most interesting, because prior to the federal tax rate lowering to 21%, we saw a lot of what's called tax inversion strategies taking place, which is kind of this, it's similar to when an individual moves out of, say, California and moves to Nevada to avoid the state taxes. So companies can do the same thing on an international level, meaning that they can move their tax base out of the United States into a different country. So for example, there's a lot of news about Pfizer wanting to move their tax base, I believe it was to Ireland, because they had much more favorable tax rates. And so even when we increase the corporate tax rates, there's a tendency to just chase dollars out of the area that you're taxing. So there's also some language in there which would force US-based companies to pay US taxes and not make it as easy for them to enact those tax inversion strategies. And then lastly, when you look at the effective tax rates that a lot of companies pay, it's actually oftentimes far less than what their marginal tax bracket is. And the reason for that is because there are a lot of tax benefits baked into the corporate tax code. So for example, software companies are oftentimes able to immediately deduct their software costs as opposed to amortizing it over the useful life of that software. And so what he's also proposing is to enact a flat tax of 15% for any firm that has a book value that's over $100 million. So in essence, it's at a minimum, these companies would be required to pay 15% once they reach a sufficient size, although it could be higher than that, up to the marginal tax bracket of 28% that I spoke about earlier.
So the bottom line here is that we are expecting to see some sort of tax increase, whether or not it's from your payroll, from your income tax, or from corporate level. The taxes are going to somehow offset the spending that we have in this country. So there's one comment in the chat box and one private questions. The comment in the in the chat box is really depending upon Georgia runoff.
Sure.
I don't know if you have the answer, but potentially this may that particular runoff could potentially make or break some of these proposals. Who knows? But let's set the politics aside. There is a private questions, I won't mention name, but it's regarding about the health savings account. And the health savings account, supposedly not necessarily that you could do a rollover like your 401k. If when you left the company, you could just roll over to another account, things like that. But I do know that health savings account, in my personal experience, I have left several places. I was able to roll over to a separate health saving. There are many financial institutes offer health savings account to hold your account for you. And I ended up with a bank who has offered that service. I roll over the money, so they don't charge any fee for me to hold the account there. On top of it, they have TD Ameritrade on top of it for me to do investment. So that's something that if you're interested, certainly look into that in terms of the rollover. All right, so there are a couple more questions that I have, which is not on the slide that you have mentioned. One of the things that we could all agree upon this year has been a really roller coaster for the stock markets. And there's up and down, and up to this point, we know that everything we lost in earlier this year has came back on. But my concern is that, are we at the peak of the market? What do you think? And what do you think that's potentially can happen next?
Yes, actually, I love this question because it's one of those that you're at the peak of the market until it sets a new high, and then that's then the peak of the market. And so one of the signs of a healthy economy and a growing, prosperous economy is that your market will keep hitting peaks, right? So if you look at the stock market starting in 1980 through the 2000s, right, you hit peak after peak after peak after peak. And imagine that you went into 1980 thinking, you know what, this market is at all-time highs. I'm not going to invest in it. Well, you would have missed out on a 20-year stock market run that was arguably the best that any of us will ever see in our lifetime. And the part that was missing in that analysis is if the market's peaking, but the economy is peaking, in other words, your gross domestic product is higher than it's ever been before, then that's not a problem. That's an indication that the financial markets are working correctly. So are we at the peak of the market? Well, in relative terms, yes, of course, because it's at all-time highs, or at least certain asset classes are. Are we at the highest peak of the market? I would strongly argue no. And the reason for that is what I mentioned earlier, is that our economy is still growing. And I actually think that's been one of the most remarkable things about the 2020 pandemic, is that there was a lot of fear that 2020 would cause us to potentially start slipping towards a pretty significant recession. And certainly 2008 still fresh in all of our minds, even though it was over a decade ago. The economic and the fundamental data from companies since then has been anything but suggesting that we're heading towards a deep recession. And in fact, we've seen the forecasted earnings for 2020 keep getting revised upward because things weren't quite as bad as what we were initially expecting. What I'm most encouraged and excited about going to 2021 and especially 2022 is the forecasted earnings that we're expecting from companies, where 2021 is expected to exceed the earnings that we experienced in 2019, and then that accelerates into 2022. Right? If the market's priced at the same way that they're pricing now, then that means that 2021 is going to set all-time highs and 2022 is going to set all-time highs. So I would never let the peak of the market deter you from investing in the stock market. However, you do want to be smart about how you're investing. Now, if you're going to go chasing something like a Zoom, right, which is at the peak of the market and at an ultra high valuation, then those kind of things don't make sense. But when done properly, I would argue that right now is probably a little bit more comfortable of a time to invest than what it was in February, March. And I think if we look back 5 years from now and see where we're at today, that we're going to be grateful that we didn't let the fear of the market being at the top deter us from investing in something longer term, which is what the stock market's intended to be anyways, which is a longer term investment vehicle.
Could we, so the peak of the market, obviously, that's a great analogy about, you need to constantly be investing, not just stop because of something happened in the marketplace. But that's a kind of reverse look at it for someone who is near retirement. Is it better off for them to retire at the peak, or is it better off for them to retire at the bottom?
Yeah, well, I mean, it depends on the type of peak that you're talking about. So here's the challenge that's facing all retirees and people near retirement, is that we used to advise people to move into safety assets. So bonds being the example, although there's other safety assets, but they all kind of work the same way. And the challenge is imagine that you're someone that's entering retirement and you've been taught your whole life that you should put 50% of your portfolio in fixed income when you retire, and you're contending with the fact that fixed income right now pays about 1%. And that doesn't include any impact that's going to happen if interest rates go up, which means that your 1% might get eroded in terms of principal because your bonds will sell off if interest rates go up. And so this is an area where, unfortunately, because we cut interest rates down to near zero, that the conventional wisdom, the conventional rules of thought probably don't work mathematically for you. And so I can't stress enough, right now is probably the most important time to have a financial plan run to where you can be realistic about the expectations going forward and make sure that your allocation meets your needs. Because if you're too conservative, right, no, you can't magically change a 1% return into the 4 or 5% that most people need for their distributions out of the account. And so you're going to have to be realistic with that, with your allocation decisions, and have a plan that you're comfortable with, that doesn't take so much risk that you're not going to sleep at night, but can realistically meet the quality of life that you're looking through the rest of your retirement years. So I think it's a great question, and I would argue probably one of the most important questions facing people entering retirement here for the next, say, 10 years.
Right. And so thank you very much for answering that. Speaking of retirement, so because of the pandemic, the CARE Acts, and all the various different rules in place this year is a little bit off compared to the rest of the other years. And one of the rule was the required minimum distribution for those people who have turned 72 by the end of, I think it's by the end of this year, that this particular year, 2020, that they potentially could have a what we call the holiday, meaning that you don't have to actually take the amount out. So questions that I've been getting was, should they just not take it? Or should they just wait until next year? Or should they just go ahead and take it? So, so how do you help clients kind of determine what is the best for them to do in terms of our?
Yeah, so this is, and unfortunately, this is true for a lot of complex questions. The answer is it really depends. It depends on what your income level is. It depends on your source of assets that you can generate income from, or get income from, I should say, rather. And so for some people, if almost all their wealth's in an IRA account, they probably don't have much of a choice where they're going to have to tap into it. Now, if you're someone that you have other assets, you don't really need to use your IRA account, then there are strategies that we can deploy this year that aren't generally available to you that might save taxes down the road. And so anytime we can save taxes, that's a wealth creation event where you'll have more money at the end of the day because you're able to save money on what you paid to Uncle Sam. And so one of the things that I'm really encouraging my clients to consider this year is a Roth conversion. And so that's the fourth bullet point that you have listed there, where let's say, I'm going to use easy round numbers just to make the math a little easier, but let's say that you would typically take a $100,000 IRA distribution every year. Right? It's probably higher than most people, but we'll just use that for the sake of this conversation. Well, what I could potentially do is to, instead of taking that, I could convert that to a Roth account. Right? I'm still going to pay taxes on that, but by converting that, I may only be in the 15 to 22% marginal tax bracket, and I now have that money growing on a tax-free basis going forward. And so by having our income levels lowered this year, it opens up strategies that may not have been available to us in previous years, because when you add up the IRA and the Social Security and the pensions and the real estate income and the dividends and interest income that we have, a lot of times there's not a lot of room left over for a Roth conversion. So the fact that we don't have to take an IRA RMD this year really opens up some room so we can do some more advanced income tax planning strategies for people.
Yeah, so I think that one of the things that I always encourage people to do is that besides of getting your certified financial planner working with you on this, like the RMD or Roth conversion, be sure to have your tax person in the same room as well. I remember earlier this year, I have a client asking the very same question of RMD holiday and then Roth conversion. I ended up having the CPA in the room to make sure that all the forecasts of the taxes is still in line with what's the best strategy for that clients to do. So speaking of the CARE Act, we also have the qualified charitable distribution. Used to be capped at $100,000, no matter how many times you do that. For this particular year, is there any special in terms of the qualified charitable distribution?
Yeah, and so, and it's important to note that there's a couple different caps, since whatever the lower amount, the other cap is that you're only allowed to do an amount up to typically 50% of your earnings in a given year, or 100% of earnings if it's a capped contribution. And so with the charitable or with the CARES Act, you're actually able to defer a lot more this year than you were in years past. So one of the things that is really a great strategy for a lot of people, especially if you have a taxable account that has a lot of securities with a lot of gains. In other words, you bought it at a low price and it's appreciated significantly since you bought it, is considering donating that to a charity, because that allows you to do two things. One is you get a full write-off for the amount of that contribution, right? But also you don't have to recognize the gains. So you don't have to pay any income taxes on the gains that those securities had inherent in them. And in 2020, you're actually able to do an additional amount, so up to 60% of your AGI, or your adjusted gross income. If you're not familiar with AGI, just think of it as being your income that you make for the year minus a few expenses that you're able to subtract away from that. But it tends to be pretty close to the amount of income that you made minus any qualified retirement plan contributions that you made. So there's a lot that people can do there if they are so charitably inclined to save taxes, and Uncle Sam allows you to be more generous, more benevolent this year in a tax incentivized manner than what we typically have. Unfortunately, there's no talks yet if those will extend into 2021, so this looks like a one-year window. But if this is something that you do want to do, you have until December 31st to do it. So definitely act now if this is something that makes sense for you.
Yeah, so you have only a few more weeks. Do your forecasting calculation. Do take advantage of this particular year's charitable contribution. The last question here is regarding about Stretch IRA. We know that last year, October, the Secure Act, that kind of this one just went away. So are there any changes in terms of for those people who still qualify, and what's your opinion about continue to use the Stretch IRA if there's.
Yeah, so this is actually one of those changes that we weren't very happy about. So what would happen in the past is that if you had an IRA account or a Roth IRA account or other tax deferred or tax-free savings account, there's an incentive to leave it to younger people because they could stretch the IRA over their lifetime, meaning that they could take distributions out of it that were commensurate with how much longer they were expected to live, to where it might last them for the next 50, 60 years. Unfortunately, for those people that are inheriting those assets, since that law was enacted, we are no longer able to use the Stretch IRA strategy. So now what the law requires is that the account has to be fully distributed within 10 years. And this is where it is very easy to make a planning mistake, because the temptation that I've seen people reach to is saying, well, then I'll just distribute it, all of it in 10 years time and let it grow either tax deferred or tax free for those 10 years. With the Roth account, that makes sense. It's a sound strategy. You don't have to pay taxes on the back end, so that definitely works. However, with a traditional account, right, remember that if you take everything out in 10 years, that means that all of that income is going to be recognized for tax purposes in 1 year, right? That's probably going to throw you into one of the highest tax brackets. It may also interfere with other things that you have going on, like college planning or other things. And so what you're going to want to do is to really map out your cash flow, or excuse me, your income rather, and figure out a plan that makes sense. And you're probably going to want to start taking funds out immediately in year 1 and continue that strategy through year 10 so that it's all depleted. And so a very different planning mindset that goes into inheriting IRAs than what we had in years past. The good news for those of you that have IRA accounts that you inherited prior to this tax law change is that you can still stretch those IRAs. So you're grandfathered into the old plan. It's only for those assets that were inherited afterwards. And then one other thing to note on this is that if you inherit an IRA from your spouse, right, so those are a different set of rules altogether, where you are allowed as a spouse inheriting assets from your deceased significant other, that you can actually take it as if it's your own plan, which is almost always what you're going to want to do. So you're not going to have to worry about distributing it entirely within 10 years, but you'd simply take the assets as if they were your own, and then the standard rules apply.
So obviously there are quite a bit of stuff that we covered in such a short time, but if there's only one advice you could give, well, I know it's very hard, what would that be?
So the big piece of advice that I would give, and it's not anything profound, but it's something that I think is often overlooked, is that the way to get wealthy is simply to live within your means and to get your money to work as hard for you as you did to earn it. If there's one thing that I can instill to further generations, to my students, to my children, it is that concept. I have met many wealthy people in my life, and very few of them hit the lottery or had a business that they sold for $10 million. The 90% of them, probably a little bit more than that, did it simply by living within their means, paying themselves first, and getting their money to work. And so the more that we can instill that knowledge within people and help them catch the vision of not having to buy every new toy, not having to try to compete with their friends, neighbors, or whomever, the better off we'll be, the more financial security that will be, and the more rich they'll be able to live their lives, because they won't have to worry about things like paying the bills, but they'll be able to do whatever fulfills them, and whatever they think will lift their communities and lead to a better environment for all of us to thrive in.
Yeah, and I totally agree. Not only just living within your means, that also becomes a very good habit as you go into retirement, because downsizing in spending is really, really, really difficult. So thank you, Jeremy, for such an informative conversation that we have today. We're so glad to have you for the Next Gen Mentoring Forum. This is phenomenal information, and the session is being recorded. So hopefully that we'll be able to share with those who cannot attend today. And I also wanted to thank California Lutheran University School of Management program for sponsoring today's Next Gen Mentoring Forum. Now, California Lutheran University School of Management, we do offer financial planning in the MBA program that helps financial advisors pursue a leadership position or grow their financial planning practice by deploying advanced financial planning techniques, effective client communication, financial counseling, as well as leveraging fintech. For more information, please sign up for our info session to learn more of how to obtain your graduate degree program. Our next Gen mentoring session is on February the 2nd, 2021. Please join me to interview Julie Kretz on Lead Like an Ally. And thank you all. And we hope you have a wonderful holiday, and we'll see you the next time in our Next Gen Mentoring Forum. Thank you, Jeremy, and thank you, everyone.
Thank you so much.